You hear what Lord Keynes says, or John Maynard Keynes, or Professor Keynes says, and he says, "Oh, we were trapped in this gold cage." But no, my argument that we were not trapped, but we were floating on a sea of fraudulent unbacked loans. Monday, December 2nd, 2024, Maneco 64, home of alternative economics and contrarian views. So today we're going to look at the gold standard. There's a lot of misconception out there, a lot of myths of why the gold standard failed. And actually, the gold standard didn't fail. The gold standard was suspended. We're going to listen to Lord Keynes, or John Maynard Keynes, back in 1931, what he said about it, and what has really happened after his comments in the last, almost 100 years. And yes, I'm going to dispel a lot of myths today, hopefully. And before I do, though, just wanted to give a shout out to my precious metals dealers, affiliates, Miles Franklin in the US, of course. And if you want to get in contact with them, all the details are below in the description. And here in the UK, of course, Gold Investments. The same goes for them. All the details are in the description. And you can call both of them on the phone and chat with them to get some help and advice. So there's a lot of myths and misconceptions as to why the gold standard was abandoned in 1931. Yes, September 21st, 1931, in the UK. One of them is that there wasn't enough gold. And the same thing goes for August 15th, 1971, not enough gold. And you hear a lot of people, actually, people who are in the alternative as well, people who should know better, who come out with this excuse that there isn't enough gold. So before I play a clip of Professor Keynes, as it's called on the clip, I'm going to show you how fractional reserve banking works, or how banking worked prior to the suspension of the gold standard. And what is a gold standard? Well, here's a coin of the gold. This is the gold standard here for the UK. And the reason why the gold standard was suspended is because technically, we're still under a gold standard, yes. If you Google gold sovereign and you go onto Wikipedia, you will find that the gold sovereign is still £1 and that it's legal tender, it's £1. So what is the standard? Well, it's the sovereign, or more exactly, about 7.33 grams of pure gold. This coin has just under 8 grams, but it's 22 karat. And why is it 22 karat? Why is it not pure? Well, because if you make it pure, you make it very delicate, and you can't like have a coin circulating 24 karat. So that's why it's 22 karat, which is 0.9166. The dollar standard, which is gold coins prior to 1934, the pre-33 coins, they were 90%, but the standard is the weight in gold. So prior to the suspension of the gold standard, and also prior to World War I, let's say I had £5 or 5 sovereigns, and it was my savings, and I wanted to deposit it with a bank because I wanted to earn maybe a little bit of interest. I wanted to put it in a savings account, or maybe I just wanted to put it there to keep it safe, but not put in a savings account. So I would go, let's say, to the Bank of England, and of course, as an individual, I wouldn't be able to go to the Bank of England. I'd have to go to a member bank of the Bank of England. But let's say I went to the Bank of England to make it simpler. I took these 5 coins. I gave it to them, and they gave me one of these, £5. So this was like going to the cloakroom in a restaurant in winter. You give them your coat and your wife's coat, and they give you a ticket saying, yeah, we've got your coat, you bring it back, we'll give it to you. That's how it used to work. So I could go back to any bank and tender this, and it still says here, I promise to pay the bearer on demand the sum of £5. Well, what does that mean? Well, it means £5 of gold. So I can go back and they give me this. So what about fractional reserve? Because the gold standard in the UK started in the early 1700s. Isaac Newton came up with the measurements for the gold standard. Yes, it was kind of suspended during the Napoleonic Wars, but then it came back in 1821 until 1914. And we were under a gold standard for all those years. And as you can see here from the Bank of England inflation calculator, inflation was minus 0.1 during that period. And it was a period of rapid industrial growth and development. One can't deny that. And we were under a gold standard. So what about fractional reserve? Because back in that period from 1821 to 1914, actually the banks only kept about 40% of their reserves in gold. So what happened when you put £5 with a bank, let's say in 1890? Well, they give you this, of course, and that would circulate. But then they would take 3 of these and lend them out, even though you didn't want to lend them out. And they used to keep 2 of these in reserve. And that worked quite well, even though technically it's fraudulent, if you want to call it, because they owe you this and they've only got this. So what they're hoping is that all the depositors that have deposited with them don't come back at the same time to redeem their notes for gold, right? For the gold standard, for the coins. And that worked really well until, of course, World War I kicked off. And war, of course, is always like a crisis, a big crisis. We saw what happened in 2020, and things change, and there's always an excuse. And the banks got caught short. And what does that mean? Well, they lent too much, and too many people were coming to redeem their banknotes because, yes, the UK government was suspending payment because they didn't want the gold leaving, because they had to finance the war. So eventually they suspended the gold standard in the beginning of the war. The other warring countries did the same. So what does it mean suspending the gold standard during World War I? Well, it meant that they could just, bankers were allowed to issue these with no backing. So let's say we got here £50. So now, they could issue £50 on the back of your £5, and they only had £5 of gold, so that's a 10% gold backing. And of course, they started issuing more and more paper to finance the war. That was the only way to keep it financed. And then after the end of the war, they had to go back like they did after the Napoleonic Wars to the gold standard. And the only way to have gone back to the same rate, £5, instead of five for 50 pounds, was to basically wipe out a lot of this debt. But what would have happened if they wipe out all this debt? Well, the banks would have collapsed, so they couldn't do it. And the Chancellor of the Exchequer, Winston Churchill, decided to go back on the gold standard at 1925 or 26 or thereabouts at the same rate as was, the same rate prior to World War I. And what that did, there wasn't enough gold, of course, to back all these loans. So industry went into a tailspin. So yeah, it created kind of a Great Depression. And eventually what the bankers decided to do through Mr. Keynes, through the advice of Mr. Keynes, who was, of course, working for them, was to basically suspend or default, really, because, yeah, people would never get their gold back. But Professor Keynes, it says here, famous economic expert, predicts great future for Britain as a result of gold standard suspension. And I'm going to play this clip in a minute, but another fallacy I wanted to talk about is the talk that there's not enough gold out there for us to be on a gold standard. So I thought it'd be good to bring this chart here from this website, omfif.org, the 7 Ages of Gold. They have an article here. And how central banks' gold policies have fluctuated over 2 centuries. But what I wanted to show you here is the supply of above ground gold stocks. And you can see that it's gone from 20,000 metric tons in 1835 to the current level. Well, this was up to 2015, but now we're almost up to 200,000 tons. So what I'm trying to say is that there will always be enough gold. And why is that? Well, because gold is money, and the reason it's been money for thousands of years is that historically, through technological advances and through population growth, yes, the gold industry is always able to grow the supply of gold, above ground gold, by 2% a year or so. And there's probably going to be an argument as well. Well, from the Bitcoin people, for example, there's too much gold. You can always find gold. Yes, and that's why it's money, because you can't run out of money. But the beauty of gold and its growth and supply is that it's been very stable vis-a-vis other goods and services in the economy, and that's why its purchasing power has remained so steady and stable throughout the millennia, and that's why it's money. So as you can see here, if we go back to 1930, all the gold in the world was about, well, not all the gold in the world, but central bank gold reserves were at 50,000. And I'm sure back then, a lot of people who wanted to suspend the gold standard were saying, well, there's not enough gold. And now people still say, well, they had to leave because there was not enough gold. And you hear what Lord Keynes says, or John Maynard Keynes, or Professor Keynes says. And he says, oh, we were trapped in this gold cage. But no, my argument that we were not trapped, but we were floating on a sea of fraudulent unbacked loans. And Mr. Keynes and the UK government, under the control probably of the bankers, well, not probably, control of the bankers, they said, you can't let us collapse. you got to suspend this and put us off the gold standard. And unfortunately, people went along with it. We didn't have social media back then, or the internet to warn people. And Professor Keynes says it wouldn't be right for us to devalue the currency or to say that 1 pound now equals 10, right? Instead of 1. But what would have been the right thing to do, in my opinion, because what this did, it saved the bankers' skin. Well, it would have been to allow the bankers to collapse, but that would have probably brought down the Bank of England as well. So that's what happened. So he also said that the exchange rate would not change, that the future was bright. But let's look at what happened to the pound during that period. So by 1940, which is 9 years after the suspension, the pound had dropped to $4.03, as you can see here. At the time of the suspension, it was at 4.86. And then by the time of the Bretton Woods Agreement, in which he was a part of, Lord Keynes, the pound had dropped to 2.8 to the dollar. And of course, now we are at below 130 to the dollar. And the other chart I want to show you is the value of the pound versus gold. And that's the fiat pound, right? Because we still have the gold pound, which is actually the sovereign. But the fiat pound, or the paper pound that doesn't require convertibility into gold, look at what it's done since 1953. And the reason I go back to 53 is because that's as far as this FX top goes. But you could get 2.4975 grams of gold with the pound back in 1953. And now you can only get 0.0145. Well, the last one is 0.149. And it's gone down, the fiat pound has gone down 99% versus the real pound, or the gold standard pound. So we've had massive inflation, of course. We are at a point right now where the government debt, the private debt, company debt is up to record highs. We have record taxation, even more than we had in the post-war period, post-World War II. And yes, it's been almost 100 years of massive inflation. And one of the ways they kind of hid the inflation after World War II was through rationing, because if you couldn't buy as many things, the prices wouldn't go up, right? And they rationed because the money wasn't good anymore. And that's what happened. So there you go. If you look up John Maynard Keynes on Wikipedia, he is the Lord Keynes, right? It seems that I would say he should be the Lord Snake Oil salesman, Lord Snake Oil. And it's interesting how still to this day, when people hear a very refined British or English accent, they always take that as someone that's very clever and knows what they're doing. But I would say don't judge a book by its cover. And yes, Lord Keynes was wrong. And unfortunately, a lot of people still follow his economic theories, right? And hopefully that will, that will change in the future. And it's one of the reasons why we are now in a debt cage. He said we were in a gold cage, but it wasn't. We were awash in a sea of unbacked loans by the banks. That's what it was. So hopefully this has cleared things up for you. So let's quickly look at where the markets are this morning. It's 8:45 a.m. London. We've got spot gold at 26.30. It's down about $20. Silver is down as well, about 42 cents at 30.20. Am I concerned? No, because there's no way out. They have to either keep inflating or they have to let the whole system implode. If they keep inflating, one of these is going to become worth a lot more of these, just like it has in the last 22 years or so. If they let it all collapse, these are going to be worthless as well, because they're not going to be able to, no one's going to have access to them, because all the loans are going to be wiped out. The only thing that will be worth something for payment is this, and silver, of course, as well. So the rest of the market is fairly quiet here. The stock market indices, the currencies are a little weaker versus the dollar. We got sterling down 1/3%. We got the euro actually down 0.75%. And we got the dollar up 1/3 versus the yen. Crude oil is a little higher this morning. WTI is up 0.75% at 68.40. What about bond yields? What about the 10-year yield? Well, that's unchanged. It's at 4.20. And this week, we've got the U.S. jobs data on Friday. That's going to be key. That's the next big event for the markets, in my opinion. And with that, I'm going to wish you all a very good day. Take care. Bye.